For this session, it is recommended that students have a calculator or at least a pencil and paper for the math-related portions. The goal of the session is to help students pass their certification and provincial exams. Disability insurance. Disability insurance, also known as income replacement insurance, protects against the loss of income due to an inability to work because of an accident, injury, or illness. In Canada, a social safety net provides some disability coverage through programs like employment insurance, EI, the Canada Pension Plan, CPP, workers' compensation, and group insurance. However, these programs have limitations and do not fully replace individual disability insurance. Self-employed individuals are covered by CPP as long as they contribute to it, but they are not eligible for EI or workers' compensation. Types of income. The two types of income discussed are unearned and earned income. Unearned income, also known as passive income, this is money received without an associated loss of income if a person becomes disabled. Insurance does not cover unearned income because there is no loss to insure. Examples include rental income, investment income, interest, dividends, capital gains, pension income, alimony received, royalties, trust income, earned income, also known as active income. This income stops if an individual becomes disabled, meaning there is a loss that can be insured. Examples include salary or wages from one or more jobs, commissions, net research grants, net business income for self-employed individuals. A core principle of disability insurance is that an individual cannot make more from a disability claim than their pre-disability income. This is to ensure there is an incentive to return to work. Insurers impose this rule by covering a maximum percentage of earned income. The standard percentage is 60%, but it can be higher depending on the occupation. For a person with both earned and unearned income, the unearned income is deducted from the total before calculating the benefit. Disability definitions. There are three crucial definitions of disability that are often featured in case studies on exams. Own occupation, the most comprehensive and expensive definition. A person is considered disabled if they are unable to perform the important duties of their specific occupation. A surgeon who loses an arm and can no longer operate would still be considered disabled under this definition, even if they can work as a professor or hospital manager. The individual would continue to receive their full disability benefit. This is typically for professionals like doctors, lawyers, and executives. Regular occupation. This definition is stricter. A person is unable to perform the duties of their own occupation and is not employed elsewhere. If they return to work in a different capacity, their disability benefit is reduced by the amount they earn from the new job. For example, if a person's total disability benefit is $5,000 per month and they earn $1,000 per month from a new job, the insurance company will pay them $4,000. This is often for white-collar workers such as office staff or supervisors. Any occupation. The strictest definition, providing the least protection for the consumer. A person is considered disabled only if they cannot perform gainful employment in any occupation. The moment a doctor says the person can go back to work, the payments stop. This is a very black and white situation with no middle ground. It is generally for blue-collar or light blue-collar workers. Presumptive disability. This is another definition to know. It presumes a person will never recover from a specific severe disability, such as a paraplegic or quadriplegic condition, loss of eyesight, or loss of speech or hearing. In such cases, there is no need to prove a loss of income, and the waiting period is typically waived. The benefits continue even if the person returns to work. Presumptive disability is only available on individual policies, not on group disability insurance plans. Policy types and riders. Three types of policies are available. Non-cancelable policy. This is the most expensive type. The insurance company cannot change the benefit period, premium, or waiting period as long as the client pays the premiums. This is where the own occupation definition is typically found. Guaranteed renewable policy. The insurer guarantees it will renew the policy until age 65, but they can change the premium. Premiums are increased for everyone in that class, not just an individual. This aligns with the regular occupation definition. Cancelable policy. This type carries the least risk for the insurance company because they can cancel the policy if they are losing money on a particular occupational class. This corresponds to the any occupation definition. Popular policy riders include partial disability rider. Pays a benefit if a person cannot perform all their duties. It is generally for a short term, 3 to 6 months, and pays 50% of the full benefit. Residual disability rider. The most popular rider, paying a percentage of the total disability benefit based on the percentage of income lost. For example, if a person loses 80% of their income, they would receive 80% of their benefit. Recurring disability rider. If an individual returns to work but becomes disabled again within 6 months from the same or related cause, the waiting period is waived and benefits resume immediately. Future purchase option, FPO allows the policyholder to buy additional insurance in the future without providing new medical evidence, based on their income increase. Cost of living adjustment, COLA increases the disability benefit over time to keep pace with inflation, often tied to the Consumer Price Index, CPI. Return of premium, ROP returns a portion, up to 80% in many cases, of the premiums paid if no claims or only minor claims are made by the end of the policy term. The returned money is tax-free. First-day hospitalization waives the waiting period for accidents that result in hospitalization. This is useful for policies with long waiting periods. Hospital indemnity rider pays a daily benefit to cover the expenses of visitors, such as lodging and parking. Exclusions. Standard exclusions in disability insurance policies include injuries sustained during a declared or undeclared war, terrorist attacks, self-inflicted wounds or attempted suicide, injuries from illegal activities, normal pregnancy, government benefits and taxation, employment insurance, EI a contributory plan with a 14-day waiting period. Benefits start on the 15th day and last for up to 15 weeks. The benefit is 55% of insurable earnings up to a maximum amount. EI benefits are taxable. Canada Pension Plan, CPP, has a 4-month waiting period. The definition of disability is severe and prolonged. The benefit period is until age 65, and the benefit amount is based on contributions. The benefits are taxable. Workers' compensation covers employees for injuries or sicknesses that occur on the job, but not outside of work. It can pay up to 90% of net income and is a non-taxable benefit. The benefit period can be for a limited time or for life. Business insurance. Disability insurance is critical for business owners, especially sole proprietors, because if they become disabled, the business income may stop while expenses continue. Business overhead expense, BOE, insurance. This policy pays for business operating expenses while the owner is disabled. It does not cover the owner's personal income. Premiums are tax deductible, but the benefits received are taxable. Disability buyout insurance, used when there are 2 or more business owners. It funds an agreement to buy out a disabled partner's share of the business. Premiums are not tax deductible, and the benefits are tax-free. Key person disability insurance provides coverage for key employees whose disability would significantly impact the business. The premiums are not tax deductible, and the benefits are tax-free. Extended health care and dental. Extended health care benefits cover expenses not included in provincial plans. These can be purchased individually or through a group plan. The 3 main areas are medical care, dental care, and travel insurance. Dental care. All plans must cover routine maintenance, including checkups, x-rays, cleaning, fillings, and extractions. They typically do not cover major restorative work like root canals or crowns. Activities of daily living, ADLs. These are the daily tasks for which a person may need assistance, such as dressing, bathing, toileting, transferring, eating, and maintaining continence. To qualify for a long-term care claim, a person must be unable to perform 2 or more ADLs. Group plan cost and funding. The method for calculating group plan premiums depends on the group's characteristics. Manual rating, used for a brand new group with no existing claims history. Experience rating, used for an existing group with a history of claims. Blended rating, used for very large groups, combining manual and experience ratings. Group plan funding formulas. Non-refund accounting, for small groups, less than 25 to 30 members. The employer pays the premium, and the insurance company pays the claims, regardless of whether there's a profit or loss. Refund accounting, for large groups, the insurance company may refund a portion of any profit back to the employer. Administrative services only, ASO, not an insurance plan. The employer pays for all claims and administrative fees, capping their costs. A risk is that the employer may not have the cash flow to pay claims.